And let me just give you, Brandon, a quick example of why I think this is important. I think a lot of us are familiar with this Ernst& Young study, where it talked about how the ideal approach, the ideal retirement approach that gives you the most income in retirement is going to be 30% of your money going towards cash value life insurance, 30% going towards an annuity, an income annuity, and then the rest going into some sort of investment. If you look at the fine print in that Ernst & Young study, it says that the whole life policy that was used in that study was used as a volatility buffer. What does that mean? That means in the year following a down year in the stock market, you live out of the cash value. You take a loan out of your cash value of your whole life policy. Mm-hmm. You use that to pay for your lifestyle. That gives your stock market portfolio a chance to recover before you take further distributions. And that act alone will allow you to take a much higher sustainable withdrawal rate on your stock market portfolio over time. In some cases, it can almost double your sustainable withdrawal rate with a 95% success rate. If you look at the fine print in that study, it says that after the stock market recovered, we paid back the loan to the life insurance policy. Well, you paid back the loan out of where? You paid back the loan out of your stock market portfolio, okay? Which means that you took money that could have otherwise been growing in your stock market portfolio and you put it into your whole life policy, right? Where it's could have been growing at 8%, now it's growing at something much less. Where you would experience a difference with the IUL is, number one, for the volatility buffer strategy to work, you need at least 3 to 5 years worth of living expenses accumulated within that policy by day one of retirement. Well, if your money's only growing at, say, 3 to 4%, it's going to take a lot of money to accumulate, and a long time perhaps, to accumulate that type of money by day one of retirement. That's what you're stuck with whole life. With IUL, if I can get 5 to 7% net of fees over time, I'm going to get 3 to 5 years worth of living expenses accumulated much less expensively or much less quickly. And when I take that loan out, I'm not going to have to pay it back. I'm not going to have to take money out of the stock market portfolio to pay back the loan on the IUL, because it's a guaranteed 0% loan. But so those are just a couple of examples of how I think the IUL could perform more efficiently over time than the whole life policy.
Yeah, I think I haven't really given enough thought potentially to using it as that equity buffer, which is going to become an interesting, probably more interesting idea for people as interest rates potentially drop back down. That's a really good point. I'm going to have to read that study.
I wrote a whole book about it called The Volatility Shield, in which I spin this financial, it's a little financial novella. It's a little sort of not a fable, but an allegory that talks about how someone literally saved their retirement by incorporating this approach. So it's a viable approach. Ernst & Young seems to really like it. There's a lot of math out there. Wade Fowle loves it. Mm-hmm. I just think that the IUL is a superior policy when it comes to building money quicker and then taking money out more in a more cost efficient way.
So let me rephrase this. You can't just go get new life insurance policies all the time, right? You can't just say, well, I started with company A in this policy and I don't like it anymore, so I'm going to get, right? It's not like it's not like changing mutual funds in your IRA, right? It's not like changing your investment opportunities. There's implications, there's costs, there's underwriting. So if you have somebody that has, say, a VUL, right? So I'm 30 years old. Say I go out and get a VUL because I can take on that risk. Well, at what point do I start looking to say, well, I should be adding maybe an IUL to this? Because at a certain point, you don't want to be like you want your in an IRA. You can at a certain point just say, well, I want less stocks and more bonds, right? You can make that shift. That you can have that glide path. With insurance products, you can't say, well, I've accumulated all this money in this VUL. I'm going to retire next year. Everything's going great in the market. Let me just go ahead and 1035 exchange this into an IUL, because although you can get the money there's surrender charges. So all of what you had available for cash value is not going to be immediately available for cash value.
Unless you do an internal exchange and the company allows you to take 100% of that cash value and apply it to your new policy.
Okay. So
that's a possibility.
So when you're looking at VULs, maybe really consider what that company has to offer for the IUL side and what their policy is around doing that.
Yeah, I mean, the big issue with that approach, and let's say you start with a VUL and you have every intention of 1035ing that into an IUL, so that it can perform, it could do the types of things that you need it to do in retirement, whether it's volatility shield or safe and productive growth or what have you. The problem is you may have every intention of doing that, but when it comes time to get that new policy and you get underwritten for it, you may not even qualify.
Right.
So, I mean, in some regards, you may be better off just doing the IUL to begin with, have that be the bond portion of your portfolio, and then to go pedal to the metal in the rest of your portfolio that's in the stock market. Just go 100% stock, leave whatever portion that's going towards your IUL. That becomes the bond portion of your portfolio. It's growing safely and productively. You're getting, it's like Tom Hegna says, reach in your portfolio, remove the bonds. Replace it with cash value life insurance. You'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, experience a better outcome over time. So it becomes your bond portfolio, and then you have a really stock heavy, allocation in the rest of your portfolio. And then you don't have to worry about the 1035s. You don't have to worry about, am I in good health when I decide to do that 1035 down the road? So that eliminates a lot of what ifs down the road. Folks, my upcoming book, The Guru Gap, How America's Financial Gurus Are Leading You Astray and How to Get Back on Track, is now available for pre-order on Amazon. Take the opportunity to order your copy today. By the way, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.